If you still believe price rises because there are more buyers than sellers, you've already fallen for the trap that smart money depends on. That idea sounds clean, logical, even obvious, but in modern markets, it's completely wrong. And the moment you believe it, you become the liquidity they exit into. So let's break that illusion right now and rebuild how you see price from the ground up using supply, demand, order books, and Wyckoff logic in a way that will permanently change how charts look to you. Because this isn't just theory, this is the difference between reacting like retail and thinking like the players actually moving the market. In the next few minutes, you'll uncover why more buyers than sellers is a misleading myth, where real supply and demand actually exist inside the order book, who truly drives price, how liquidity gaps create explosive moves, and how Wyckoff's volume versus price logic reveals the hidden battle between institutions and the crowd. By the end, those random candles won't look random anymore. You'll see conflict, intent, and strategy playing out in real time. Let's dismantle the biggest misconception first. People say price went up today because there were more buyers than sellers. It sounds right, it feels right, but it's fundamentally flawed because in every single executed trade, there is always one buyer and one seller. Always, the number of units bought equals the number of units sold. No exceptions. So mathematically, there can never be more buyers than sellers in completed trades. So what actually changes? This is where things get interesting. It's not about quantity, it's about behavior. Who is more aggressive? Who is more patient? Who is willing to cross the spread and force execution? Price doesn't move because some extra buyer magically appears. It moves because one side starts attacking and the other side either can't absorb it or chooses not to. To truly understand supply and demand, you need to see what most traders ignore, the difference between two types of orders. First, limit orders. These are patient, controlled, strategic. I'll buy at this price or better. I'll sell at this price or better. These orders sit quietly in the order book, waiting. They don't chase price, they define the battlefield. This is where real supply and demand live. Then you have market orders. These are impatient, urgent. Fill me now. I don't care about price. These orders don't wait. They attack. They cross the spread, consume what's sitting there, and force price to move. Here's the key shift you need to make. Limit orders create the structure, true supply and demand. Market orders create the movement. They're the force that crashes into that structure and shifts price up or down. In Wyckoff terms, supply and demand exist in limit orders. Price movement comes from market orders smashing into them. Now watch what actually happens when price moves. Price moves up when aggressive market buyers hit the sell limit orders sitting at the ask. If those buyers keep pushing, they consume all available sellers at that level. Once that supply is gone, the next available sellers are higher, so price ticks up. And here's where it accelerates. If short sellers have stop losses just above that level, once triggered, those stops turn into market buy orders. Now you have forced buying stacked on top of real buying. That's how short squeezes ignite. On the flip side, price moves down when market sellers attack the buy limit orders at the bid. Once those bids are absorbed, the next buyers sit lower, so price drops. And just like before, long traders' stop losses get triggered, turning into market sells. That's how liquidation cascades happen, selling feeding more selling. So the real summary is this: market buys lifting offers push price up. Market sells hitting bids push price down. Not more buyers or sellers, just more aggressive participants on one side overpowering the other. But here's where it gets even more powerful. Price doesn't only move because one side is strong. Sometimes it moves violently because the other side disappears. Think about a supermarket. Today, water costs $1 a bottle. Tomorrow, most suppliers vanish and the shelves are nearly empty. Do you need massive demand for price to rise? No, even a few buyers can push price up because supply is gone. That's exactly how markets behave. If sellers pull their limit sell orders, the ask side becomes thin. Now even small market buys can push price sharply higher. If buyers pull their bids, the bid side weakens. Suddenly, even modest selling can cause steep drops. This is what is called a liquidity gap. Price doesn't jump because everyone is suddenly bullish or bearish. It jumps because there's no one on the other side to slow it down. Wyckoff described these as no supply or no demand conditions, and they're critical for spotting when trends can accelerate or reverse. Now, let's bring in one of the most powerful tools you can use, Wyckoff's volume versus price logic. This is where you start reading the story behind the chart. Think of volume as effort. Think of price movement as result. You don't need to know exactly who is buying or selling. You just compare effort to outcome. Here's how that plays out. High volume but small price movement means massive effort with minimal result. One side is pushing hard, but the other side is absorbing everything. For example, heavy buying into resistance where price barely moves higher and closes weak. That's strong supply sitting above, quietly taking the other side. High volume with large price movement, that's effort producing result. The dominant side is in control. It could be a powerful breakout or a climax at the end of a move. Context tells you which. Low volume but big price movement, that's where things get deceptive. Small effort, big result. That means the opposing side has vanished. This is your liquidity gap again, either trend continuation in a thin market or a manipulated move where price travels easily because there's no resistance. So now, every time you look at a candle, you ask a different question. Given this level of effort, this volume, is the result strong, weak, or suspicious? That's how Wyckoff reads the battle beneath the surface. And all of these mechanics, limit orders, market orders, liquidity, volume, they all plug into a bigger framework, the Wyckoff cycle. This is where everything comes together. First, accumulation. Smart money quietly builds positions while price moves sideways. You'll notice high volume on down moves, but price refuses to break lower. That's absorption. Supply is being taken in. Then comes markup. Demand takes control. Pullbacks are shallow. Down moves happen on lower volume. Breakouts don't fail, they continue. Next is distribution. This is where smart money offloads positions to the public near the top. You'll see strong upward moves on high volume, but no follow-through. That's supply stepping in, overpowering demand. Finally, markdown. Supply dominates. Rallies are weak. Up moves lack volume, and price continues to fall. Your job isn't to predict every move perfectly. That's a losing game. Your real job is to read the phase. Who is accumulating? Who is distributing? Is the market absorbing or unloading? So here's a simple checklist to anchor everything. Next time you open a chart, forget more buyers than sellers. Instead, ask who is more aggressive right now. Think in terms of orders. Limit orders define supply and demand. Market orders move price. Watch liquidity closely. A thin order book means small orders can create big moves. A deep book means even large orders may barely move price. Then read effort versus result. High volume with little movement signals absorption. Someone strong is on the other side. High volume with strong movement shows dominance or exhaustion. Low volume with big movement signals lack of opposition, a liquidity gap. And finally, place yourself inside the Wyckoff cycle. Are you in accumulation, markup, distribution, or markdown? Are you trading alongside smart money or unknowingly providing the liquidity they need to exit? Once you start seeing the market this way, everything changes. You stop chasing green candles. You stop reacting emotionally. And instead, you start recognizing where positions are being built, where traders are getting trapped, and where the real opportunities are hiding. If this shifted how you see the market even slightly, hit like, subscribe, and tell me if you want a deep dive specifically on Wyckoff accumulation and distribution setups, because once you truly understand those, you'll never look at price the same way.